All right, welcome to this explainer. Today we're diving into a genuinely fascinating financial mystery buried in Muthoot Finance's latest FY26 earnings report. Now, if you follow the NBFC sector at all, you already know Muthoot is an absolute titan in the gold loan industry. I mean, they command roughly a 30% market share. But their latest numbers, they've sent some incredibly mixed signals to the market, creating what we're calling a true profit paradox.
Think about this for a second. Muthoot's board recently approved an interim dividend of 30 rupees per share. That's a massive 300% rate, making it officially the absolute largest dividend they've ever paid out in the company's history. Usually, when a company drops that kind of unprecedented capital back to shareholders, it's a huge flex for management. It screams confidence. So, by all conventional logic, a record payout like that should trigger a massive stock surge, right? Shareholders should be ecstatic. And yet, on the exact same day that momentum was building, the stock took a brutal beating, dropping over 11% intraday.
It's a total paradox. On one hand, you have a fundamental business driving a staggering 98% annual profit jump right alongside that record-breaking 30 rupee dividend. But on the other hand, the market reacted with sheer panic, driving that double-digit crash. You've literally got a thriving business returning unprecedented capital while institutional investors are hitting the panic button. So to understand why seasoned pros and retail investors alike started selling despite those glowing headline numbers, we really need to deconstruct the latest earnings data. We're going to break down both the underlying bull case and the immediate bear case to figure out exactly what the market is pricing in here.
So let's kick things off with the structural tailwinds pushing the company forward, because the broader macroeconomic environment in India is incredibly favorable right now. The organized gold loan market isn't just growing, it is actively accelerating, and it's projected to hit a massive 16 lakh crore rupees by FY 2026.
Get this, the overall gold loan market is just booming, completely redefining the retail credit space. It's actually outpacing all other retail credit products with a massive 84% year-over-year growth in FY26. To put that into perspective, just a year prior, that growth was sitting at 69%. Rising gold prices have obviously been a massive catalyst here. Because the underlying asset appreciates, borrowers can unlock much larger loan amounts against the exact same collateral. In fact, average ticket sizes have nearly doubled from just under 1 lakh in FY23 to nearly 2 lakh in FY26. From an analyst's perspective, this is a dream. It massively increases Muthoot's loan book density without them having to process twice as many individual customers.
And here's the kicker. This isn't just a southern India story anymore. Historically, gold lending was a highly concentrated regional phenomenon. But look at these year-over-year sourcing growth figures from a recent Experian report. Uttar Pradesh is up 138%, West Bengal up 112%. We're seeing triple-digit growth in Rajasthan and Maharashtra. This is a true pan-India acceptance of gold-backed lending, which fundamentally alters Muthoot's total addressable market. They aren't boxed into regional boundaries anymore. The entire country is essentially their playing field now.
But it's not just where this is happening, it's how it's happening. We're seeing a massive structural shift where borrowers are intentionally using gold loans for business expansion rather than just distressed emergency pawning. You know, back in the day, gold loans were mostly sourced from local, informal money lenders for desperate situations. Today, borrowers are actively migrating to formal, organized lenders like Muthoot for safer custody, transparent valuation, and fairer rates. For investors, this is the holy grail. You have a product evolving from a distressed emergency measure into a highly reliable engine for micro-enterprise working capital. Shop owners and small businesses are proactively using this credit to fund inventory, which creates a much stickier repeat customer.
Now pair that physical expansion with a massive digital shift. Muthoot is successfully capturing a whole new generation of borrowers through a very deliberate phygital transformation. Obviously, their massive footprint of almost 5,000 branches is the foundation of their trust, but management totally gets that modern scale requires a highly efficient digital layer. They're actively shifting customer interactions from the traditional teller window straight to the smartphone.
Enter the Muthoot app. By integrating this digital layer, they've radically streamlined customer onboarding and repayment without abandoning that physical branch foundation. I mean, customers can now top up existing loans, pay interest, and apply for new products in literally minutes from their couch. The app has already seen over 25 million downloads, bridging the gap between their massive physical network and the modern expectation of instant service. And crucially for the bottom line, this digital shift is absolutely vital for trimming heavy operational costs in what has traditionally been a very labor-intensive brick-and-mortar business.
Just check out this number, 71%.
An incredible 71% of all gold loan top-ups are now initiated seamlessly through the app. That is a 65% year-over-year increase in digital top-ups alone. Furthermore, 42% of gold loan interest repayments are now happening via the app, which is up 137% year-over-year. This kind of digital infrastructure dramatically reduces the day-to-day operational burden on those physical branches. It frees up their employees to actually go out and acquire new customers rather than just drowning in routine paperwork.
And this momentum is bleeding right into their subsidiaries too. Muthoot Money, for instance, which operates almost 1,000 branches of its own, is rapidly transforming into a vehicle and gold loan powerhouse with a staggering 151% growth in AUM. Plus, they're showing immense fundamental strength, pushing their capital adequacy ratio to a highly secure 27.1%. Meanwhile, you have Belstar Microfinance and Muthoot HomeFin continuing to diversify the overall group portfolio. When you combine that subsidiary strength with the pan-India gold market tailwinds and their aggressive digital shift, the company's long-term trajectory looks incredibly robust.
Okay, so with all these massive tailwinds, the expanding TAM, the digital adoption, why the panic? Why did institutional investors hit the sell button? Well, while the annual figures are undeniably positive, institutional money lives and dies by quarterly momentum. And when we zoom into the micro-level data of the most recent quarter, some very real cracks start to show.
The true culprit for the stock crash lies right here in the sequential data. While the year-over-year numbers look amazing, net profit actually dropped over 16% compared to the immediate previous quarter, even though net profit for the June quarter hit nearly 2,800 crores, which is up roughly 39% year-over-year. It represented a sharp 16.43% quarter-over-quarter decline. Interest income followed the exact same pattern, up nicely for the year, but down 6.64% sequentially. The market saw this quarter-over-quarter moderation and immediately started asking some very tough questions about long-term sustainability. When you pop the hood on that June quarter, some specific red flags pop up. Investors quickly realize that profitability is facing intense pressure, despite the rapidly growing loan book. For example, lending yields declined much faster than the street expected. The reality is, the gold loan space is getting fiercely competitive. Because gold loans are so secure, backed by incredibly liquid collateral, every major bank and rival NBFC wants a piece of the action. This aggressive fight for market share forces market leaders like Muthoot to slash yields just to retain their customers. They basically have to either sacrifice top-line growth or sacrifice profit margins. And right now, it looks like margins are taking the hit.
Then there's the cost of growth. Consolidated operating expenses actually shot up by 30% in the first 9 months of FY26. We're talking higher variable pay, rent, and massive advertising costs. Employee expenses specifically jumped by up to 36%. Muthoot has been spending heavily to capture that explosive market growth we talked about earlier, including those massive high-production ad campaigns fronted by Amitabh Bachchan. But that growth is coming at a steep operational cost. This skyrocketing customer acquisition cost is eating directly into the bottom line, which explains a big chunk of that sequential profit drop.
And to make matters tighter, the cost of funds is creeping up, largely because banks haven't materially reduced their lending rates yet. Muthoot's calculated cost of funds on their standalone business ticked up to 8.8%. With roughly 50% of their loans linked to the marginal cost of funds-based lending rate, they are highly exposed to broader bank rates. Until banks actually start dropping those rates, Muthoot's cost of capital remains painfully high. So it's a classic double whammy margin squeeze, right? They're forced to charge customers less to stay competitive, while banks are charging them more to borrow the money in the first place.
So where does that leave us with Muthoot Finance? It really comes down to balancing this record annual expansion against tightening quarterly margins. You have a company that is undeniably a best-in-class operator. They are successfully expanding out of the South, they are digitizing their customer base, and they're riding a massive macroeconomic gold rush. But they're simultaneously fighting a fierce, expensive margin war on a quarter-to-quarter basis.
For their part, management is stepping up to calm the waters, pointing to stabilizing yields and suggesting they might even upgrade their 15% AUM growth guidance soon. They've explicitly stated they expect their net interest margins to hold steady between 10.5% and 11%. If management can actually deliver on this promise to stabilize those margins while maintaining their current pan-India loan growth trajectory, the recent sequential dips might just be a temporary blip rather than a permanent structural trend. Which leaves us with the million-dollar question. With an unmatched market share but undeniable margin pressure, is this recent dip the perfect entry point or a glaring warning sign to stay away? Is the broader market just overreacting to a single quarter of margin compression? completely ignoring the long-term potential here? Or are we seeing the early stages of a relentless margin squeeze that will drag the stock down further? It is a fascinating paradox and definitely one that every serious financial observer should be keeping a very close eye on. Thanks for joining us for this explainer, and we'll see you next time.